Good morning, student friends. With due respect to the departmental initiative on the creation and development of e-content, in this session, we will discuss on average rate of return, problems and solution, and also return on per unit of investment with practical problems. For the program, become subject financial management of 5th semester, Vijayanagara Sri Krishnadevara University, Ballari. Average rate of return. In the previous session, we have studied the theoretical aspect on the calculation of average rate of return. Just to revise, average rate of return, it establishes the relationship between average annual profit to the total investment. The average rate of return is to be calculated with the formula total profit after depreciation and taxes divided by net investment in the project into number of years into 100, or average rate of return is equal to, instead of total profits after depreciation and taxes, we have to take average annual profit and divided by net investment in the project into 100. The return per unit of investment method. This method is having a small variation with the average rate of return, just slight change in the formula. In this method, the total profit after tax and depreciation is divided by the total investment. Return per unit of investment is equal to total profit after depreciation and taxes divided by net investment in the project into 100. Here is an example. Ashoka Limited proposes to purchase a machine for its expansion project. The particulars of two machines are given and it is in a tax bracket of 30%. Particulars: machine A, machine B. Three columns are here. Cost is given 60,000 each. Life is also same, 6 years. Profit before tax is given. First year 15,000, 20,000. Second year 20,000, 15,000. Third year 30,000, 20,000. Fourth year 20, 30,000. Fifth year 38,000, 40,000. Sixth year 45,000, 55,000. Total profit before tax of a machine A is 1,68,000 for 6 years. Similarly, for the machine B, total profit before tax is 1,80,000 and the firm is in a tax bracket of 30%. So here in this question, Ashoka Limited want to purchase a machine for its expansion of business. Here there are two options, machine A and machine E. Machine B, the cost is given, estimated life is given, and the 6-year profit before tax is given. The solution: calculation of profit before tax. First working note you have to find. Here machine A total profit is given 1,68,000 and machine N total profit is 1,80,000 for 6 years. So we need to find, this is the profit before tax. So you have to minus the tax. 1,68,000 into 50%, that comes to 84,000. So 1,68,000 minus 84,000 is equal to 84,000. Similarly, machine N, the profit before tax is 1,80,000. 1,80,000 into 50% tax, that comes to 90,000. So the profit after tax comes to 1,80,000 minus 90,000, that is 90,000. The second one is the calculation of average profit. As we know, average profit is total profit divided by total number of years. Machine M, the total profit is given after tax. In the question, the total profit is given 1,68,000, that is before tax. So you should take the profit after tax. Total profit 84,000 divided by 6, and that comes to 14,000. Machine N 90,000 divided by 6, that comes to 15,000. So in this slide we have calculated the profit before tax. Instead of taking each year's profit and subtracting the tax, altogether the total profit minus the tax bracket, so you'll get the profit after tax. And similarly the average profit, all the total profits are to be added. Total profit is 1,68,000 before tax it is, but after tax is 84,000. That 84,000 divided by total number of years, 6 years. So the average annual profit comes to 14,000 for machine M, and for machine N it is 15,000. Very simple calculations. Third step, you have to calculate net investment. Net investment is nothing but total investment minus scrap value. In this question there is no scrap value, so the cost of the asset, that itself is a net investment, and that is 60,000 for both machine M and N. Now the last step, the calculation of average return on investment. Average return on investment is equal to average profit divided by net investment. So we have calculated average profit. Machine M is 14,000. Net investment is there 60,000 into 100, that comes to 23.34%. For machine M, and for machine N it is 15,000 divided by 60,000 into 100 is equal to 25%. So here, which is giving the higher rate of return, that is to be accepted. When you compare the machine M and N having same life, the rate of return is, average rate of return is 25%. So it is advised to the management to buy a machine N, as its average rate of return on net investment is higher. Book example. Book example 2. Calculate average rate of return from the following data given below. Cost of investment 6,30,000. Scrap value at the end of 5 years 30,000, and it expected to yield the profit after depreciation and taxes. Here this profit is after depreciation and taxes. For the 5 years the profits are 50,000, 70,000, 80,000, 60,000 and 40,000 respectively. So similarly you have to find out the average profit. Average profit is equal to total profit or minus total losses divided by total number of years. So all years profit is given. 50,000, 70,000 becomes 1,50,000 plus 80,000, 150 plus 80, that is 230 plus 60, 290 plus, sorry, 50 plus 70 it becomes 120, 120 plus 80 becomes 2 lakh, 2 lakh plus 60, 2 lakh 60,000 plus 40,000, that comes to 3 lakh divided by 5 years, 5 6 the 30, so 60,000 is the average profit. Net investment, initial investment is 6,30,000. In this problem they have given the scrap value 30,000, subtract it, so the net investment will be 6 lakh. So the average calculation of average return on investment. Apply the formula. Average return on investment is equal to average profit divided by net investment into 100. 60,000 divided by 6 lakh into 100, that comes to 10%. Now return on per unit of investment is equal to total profit after tax and depreciation is 3 lakh divided by net investment 6 lakh into 100, that is 50%. The calculation of average rate of return will take the average profit, and return on per unit will take the total profit. That's the difference. So the example number 3, calculate, the students you are advised to solve this problem. Calculate return on per unit of investment from the following data given below. Cost of investment 13 lakh, scrap value 1 lakh, and it is expected to yield the profit after depreciation and taxes during the 5 years. Here the loss is given in the first year 1,50,000, 1,70,000, 1,80,000, 1,60,000, 1,40,000. The only difference was here the 4-year profits are given and 1-year loss is given. While calculating average profit, total profit minus total loss divided by total number of years. So the total calculation of total profit after tax and depreciation. So total profit 1,70,000, 1,80,000, 1,60,000, 1,40,000, and 1-year loss is there 1,50,000. So the total profit becomes 6,50,000. If you minus the loss 1,50,000, it comes to 5 lakh. Net investment is given. In this question, they are asked only to find out per unit. So the formula we will consider only the total profit, not the average profit. Calculation of net investment. Initial investment is 13 lakh minus scrap value 1 lakh. So the total will be 12 lakh. So the calculation of return on per unit of investment. When you take the per unit, the formula is total profit after tax and depreciation divided by net investment into 100. Net investment is 12 lakh and the total profit is 5 lakh. Into 5 lakh divided by 12 lakh into 100, that comes to 41.67%. For this question, they have not asked the average rate of return, but still we can calculate average rate of return is equal to average profit divided by net investment into 100. So the 5 lakh is the total profit for 5 years. So 5 lakh divided by 5 years, 1 lakh is the average profit. 1 lakh divided by 12 lakh into 100, that comes to 8.34%. For this, we have referred the book Shashi and Gupta, R.K. Sharma, that is Management Accounting Principles and Practice, Kalyani Publishers, and also a book of Financial Management by G.V. Baligar, Ashok Prakashan, Hubli. Thank you, one and all.